Welcome to Wealth Echelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. In the world of investing, growth ETFs like QQQ, SCHG, and VUG have become household names for those chasing market-beating returns. These funds represent some of the most dynamic, innovative, and rapidly expanding companies in the U.S. stock market, making them favorites among investors looking to capitalize on economic growth and technological advancement. But when markets tumble and fear grips investors, the race to recover lost ground begins, and not all growth ETFs bounce back equally or at the same speed. At first glance, it may seem that some ETFs simply get lucky with a quick rebound, while others lag behind, fueling speculation that recovery is a matter of timing or pure chance. However, this couldn't be further from the truth. Behind the scenes, a complex interplay of carefully designed factors, such as index construction methodologies, sector concentration, market capitalization weights, and the behavioral patterns of investors, dictates which ETFs recover faster and why. These variables create a structural blueprint that shapes the speed and trajectory of recovery following market downturns. For example, QQQ's heavy concentration in mega-cap technology giants often positions it to leap ahead during rebounds fueled by innovation and rapid growth, while SCHG and VUG, which maintain broader sector diversification, typically experience a more measured recovery pace. If you've ever been puzzled by why QQQ sometimes seems to sprint ahead in market recoveries, while SCHG and VUG follow a steadier, more gradual path, this article will peel back the layers to reveal the real drivers behind these outcomes. It's not random chance, timing, or luck. Instead, it's a carefully engineered result, rooted deeply in the DNA of each ETF's design and the market dynamics they operate within. Understanding these nuances isn't just an academic exercise, it's a vital piece of knowledge for anyone looking to make smarter, more confident investment decisions. By recognizing how index construction and investor psychology influence recovery patterns, you can better align your portfolio with your individual goals and risk tolerance, knowing what to expect when the market turns volatile. So buckle up as we dive deep into the world of growth ETFs, analyzing their core differences, dissecting how sector exposures influence their resilience and recovery, and exploring the behavioral finance elements at play. By the end of this exploration, you'll see clearly why recovery speed isn't a matter of luck or happenstance. It's a predictable, strategic outcome that savvy investors can understand and leverage to their advantage. When investors seek exposure to the high-growth segment of the U.S. stock market, three popular exchange-traded funds often come into focus: QQQ, SCHG, and VUG. At first glance, they may appear to offer the same benefits: growth potential, exposure to technology, and access to innovative companies. But a deeper look reveals critical differences that shape their performance and recovery paths during market downturns. QQQ tracks the NASDAQ 100 index, which is heavily weighted in mega-cap tech giants such as Apple, Microsoft, and Amazon. This ETF captures the essence of America's most dominant and innovative non-financial companies. SCHG, on the other hand, follows the Dow Jones U.S. Large Cap Growth Total Stock Market Index, providing exposure not only to the tech sector, but also to other industries such as healthcare and consumer discretionary. Meanwhile, VUG tracks the CRSP U.S. Large Cap Growth Index and represents a broader range of large cap growth companies with a slightly more diversified approach than QQQ. These subtle differences in index composition directly influence how each ETF behaves during and after market corrections, and understanding these mechanics is the first step toward proving that faster recovery is not mere luck, but a function of design and structure. The weight of giants, why QQQ often bounces back quicker. One of the main reasons QQQ has historically recovered faster than its counterparts is its concentrated exposure to the technology sector, which often leads market recoveries after economic slowdowns. During the 2020 COVID-19 crash, for example, technology stocks were the first to rebound as the world shifted to digital services, remote work, and e-commerce, areas dominated by the top holdings in QQQ. With giants like Apple, Microsoft, Nvidia, and Amazon accounting for a significant portion of QQQ's total weight, the ETF benefits when these companies announce strong earnings, launch new products, or disrupt entire industries. This is not luck. It is intentional exposure. When macroeconomic fears recede, investors tend to pour capital back into these tech leaders due to their superior margins, scalability, and ability to adapt to changing consumer behavior. In contrast, SCHG and VUG, while also growth-oriented, have broader sector exposure, which includes industries that may lag during an economic recovery, such as healthcare or industrials. These sectors often have longer business cycles, regulatory hurdles, or supply chain dependencies that delay their bounce-back period. Therefore, QQQ's sharper and quicker recovery reflects a structural advantage built into its index methodology, not chance. The role of index construction, SCHG's defensive diversification. SCHG presents an interesting contrast in that its more diversified exposure across multiple sectors can make its recovery slower compared to QQQ, but smoother in volatility terms. SCHG includes companies from sectors such as healthcare, consumer staples, and financials, which may not surge immediately when risk appetite returns to the market, but provide resilience during the downturn itself. This diversified basket is intentionally designed to moderate the extremes of growth investing, reducing the impact of sharp drawdowns. While this may sound like a disadvantage in terms of rapid recovery, it's actually a feature that aligns with the fund's long-term growth philosophy. To capture broad-based growth trends across the economy without overexposure to a single sector's cyclicality. When the economy recovers in a balanced way across industries, as opposed to a tech-driven recovery, SCHG's constituents can deliver steady gains that build over time rather than deliver sharp, short-term rebounds. Therefore, SCHG's slower recovery pace isn't due to randomness, but due to the deliberate construction of its index, which prioritizes diversification and broad participation over concentrated tech bets. VUG's balanced approach, the middle ground of recovery speed. VUG stands as the middle ground between the high-octane tech exposure of QQQ and the broader diversification of SCHG. Its tracking of the CRSPUSLARGECAPGROWTHINDEX means it holds names that are both tech-centric and growth-oriented, but also includes exposure to sectors that give it defensive characteristics, such as healthcare and consumer services. This balance means that while VUG does benefit from the same mega-cap tech rebounds that power QQQ, the weight of these companies is not as dominant within VUG as it is in QQQ. Consequently, VUG often shows a recovery profile that sits between QQQ and SCHG, not as sharp and immediate as QQQ's tech-led surges, but faster than SCHG's more gradual, diversified resurgence. VUG's design is not accidental. It is a product intended for investors who want exposure to U.S. large-cap growth with some risk moderation. Its recovery characteristics stem from this purpose-driven design. During market stress, the mix of growth and defense within VUG smooths out volatility, and during recoveries, the participation of tech stocks ensures it does not lag the broader market. This deliberate construction explains why VUG recovers the way it does, rather than leaving its performance to the whims of market luck. Market cycles and behavioral finance. Why recovery speed is predictable. Another important reason why the recovery patterns of these ETFs are not a matter of luck lies in the psychology and behavior of market participants. After market crashes, investors tend to flock toward companies and sectors with strong balance sheets, pricing power, and technological innovation, qualities found predominantly in the holdings of QQQ. Institutional investors, hedge funds, and retail traders alike see these tech giants as safe bets for capital appreciation in uncertain times. This behavioral tendency accelerates QQQ's recovery after downturns. In contrast, broader funds like SCHG and VUG receive inflows at a slower pace because they include sectors that investors may view as less immediately responsive to economic rebounds, such as healthcare or consumer goods. Furthermore, sector rotation, the movement of capital between different parts of the market based on economic expectations, plays a critical role. In early recovery phases, technology and communication services, dominant in QQQ, attract the bulk of inflows, while defensive or lagging sectors in SCHG and VUG receive renewed interest later in the cycle. These predictable patterns of human and institutional behavior make the recovery paths of these ETFs anything but random. They follow well-understood rules of market psychology, index exposure, and sector momentum. Historical performance as proof. Lessons from past corrections. Looking back at major market corrections provides concrete evidence that recovery speed is not a matter of luck, but a reflection of ETF design and market dynamics. During the dot-com bubble burst in the early 2000s, technology-heavy funds like QQQ suffered deeply, but were among the first to recover when innovation-driven growth resumed in subsequent years. Similarly, during the great financial crisis of 2008 to 2009, growth ETFs with tech exposure staged sharper recoveries than broader market funds because technology adoption accelerated even as the economy rebuilt. The COVID-19 pandemic crash of 2020 offers the clearest example. QQQ hit new all-time highs mere months after the crash thanks to the soaring value of tech megacaps, while SCHG and VUG took longer to reach their pre-crisis levels as recovery broadened into other sectors. These historical patterns reveal that ETF recovery speeds correlate directly with sector exposure, index concentration, and macroeconomic drivers, not randomness. Market crashes and recoveries are shaped by predictable forces such as Federal Reserve policy, technological adoption trends, consumer behavior shifts, and corporate earnings surprises, all of which systematically favor certain ETFs over others depending on their portfolio structure. Thus, QQQ, SCHG, and VUG follow recoveries not because of luck, but because of structural, repeatable advantages or constraints embedded within their design. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.